as we bring in our panel, talk all about today's CPI print. Oh, we get the PPI. Everybody is talking about the inflationary environment. It came in hotter than expected, higher than expected. That means that the Fed won't be cutting rates anytime soon. Eric Gerster is with us, Chief Investment Officer at AlphaCore Wealth Advisory, and Jay Hatfield, Chief Investment Officer, Infrastructure Capital Management. So it looks like we're going to have a higher for longer rate environment coupled with a slightly hotter inflation print. Jay, what was your takeaway from today's print?
Well, we were more sanguine in the market, which is, partly the reason the market's not down is because of tech. But if you really start to analyze that data, first of all, the January data is typically pretty dirty. And you've got some components that are up like 24% on an annualized rate, which probably isn't going to continue. But more importantly, the implications so far of CPI for PCE core is only a 0.3% increase. And keep in mind, last year we had 0.5. So we would roll down from 2.8 to 2.6, which would be a level where if we had a rational Fed, which we may not, they could cut from there. And we also think the economy is weakening, which everybody's missing. Just look at the data. It's not really secret data. So we are still forecasting 3 rate cuts starting not this quarter, but next quarter. And we think this bond sell-off is massively overdone.
Ah, that's really interesting, Jay, because not too many folks are saying what you're saying. So that's an interesting point. I like hearing it. I like thinking about it. And I like discussing this. Eric, your thoughts?
Yeah, I think the Fed's on hold easily for the first half of the year and possibly the entire year. So they're facing a lot of headwinds from the new administration, tariffs, taxes, immigration, DOGE, and these are countervailing forces. And we're just going to have to wait and see how they play out. Some of those are potentially inflationary policies, some of them potentially pro-growth. And we're going to have to wait and see how that plays out. And that's going to impact how people invest throughout the year. You also have a market that is expensive in the stock market.
So what's your investment play here based on your thoughts, Eric, that the Fed's not pausing, at least for now, and maybe for the entire year? What's your best advice to investors?
Yeah, so I think within the equity markets, we're focusing on high cash flow growing companies that trade at values that make sense for the cash flow they grow. In alternative credit we like because we think there are opportunities within structured credit, direct lending to private equity-backed companies to earn equity-like returns with more downside protection because you're able to get yields of 10+%. So we like that, and we would stay away from the high growth, lower no cash flow stocks that have had a really big run the last couple of years.
And so, you're talking about cash flow and looking for growth, and obviously a different vibe than what Jay may be saying. Jay, you were a little more cautionary. What would your strategy be for investors? What do you tell them?
Well, we are far more optimistic than most. So we have a 7,000 target on the S&P. We do think that non-tech companies will outperform. But what we would watch for is really this tax bill, and it's starting to take shape. But the critical element for investors is not the personal tax cuts, but is there going to be incremental corporate tax cuts? Because our 7,000 target is dependent on an 18% effective corporate tax rate. If we don't get that, that 6,600 would be our target, which would be a pretty ordinary year. So we have this massive inflection of what is this tax bill going to look like. And so we are waiting for that before we would counsel people to just go all in on this market. Is let's figure out, not necessarily listen to every new announcement out of the administration because they're coming fast and furious, but let's see what gets codified in a real bill in terms of cuts to spending, what kind of individual income tax cuts, so that's not very important to the stock market. And then, but more importantly, the corporate tax cuts.
Right, so rate cuts, tax cuts, and that could give a boost to the S&P 500. Your final thought here, Eric, when you think about investors and putting some cash to work, the 6,600 to 7,000 is Jay's target. Final thoughts here.
Yeah, I think clients have to be thinking about the long-term view of the U.S. economy, which we're very optimistic on. AI is driving a productivity boost. The overall economy, whether slowing in the short term or not, we think over the next 3 to 5 years looks very good. And so from a long-term perspective, we continue to like equities. We continue to like, as I said, the alternative credit, and try not to get too caught up in the noise of one data point on any given day.
Great to see you both, Eric and Jay. Thank you so much. Eric Gerster, Jay Hatfield, thank you.